We're going to look at the first of the 4 categories of adjusting entries, deferred expenses. So we know a deferral is when the cash transaction already happens. So when we're talking about a deferred expense, we're talking about cash being paid before the expense happens. So the cash is paid earlier in the period, and then later in the period, the expense has been incurred, right? And so back in Chapter 1, we talked about this. We called that a prepaid expense, when you pay for an expense in advance. You pay for an expense before it happens. It's not an expense because it hasn't been incurred. It's an asset account called prepaid expense. We talked about prepaid rent and prepaid insurance. It could be prepaid advertising. So then what happens after you pay for the expense, as time goes by, you incur the expense. So then we need to record the expense as if it has been incurred. So at the end of the period, we look back at our prepaid expenses and we see if any of those expenses have been incurred. If they have been incurred, we need to record it as an expense. So we're going to make an adjusting entry to record the expense. And then we also need to show that that asset account, prepaid rent, prepaid insurance, prepaid advertising, has gone down because we've used some of it up. It's not prepaid anymore. So here's a transaction we would have seen back in Chapter 2. So back in Chapter 2, we would have seen a transaction where we paid 6 months rent in advance. So when that happened, we debited prepaid rent and credited cash. Okay, so this is a Chapter 2 transaction. This is not an adjusting entry. And even if we looked at it real quick, we'd know it's not an adjusting entry because it involves cash. And you will never use cash in an adjusting entry. The adjusting entry happens at the end of the period. At the end of 1 month, we have to make an adjusting entry because now we've occupied the space for the month. We've incurred the rent expense. So we have to make a journal entry to show this month's rent expense and to show that the prepaid rent asset account has gone down. So if we take, there we go, the $3,600 is what we paid for 6 months rent. We can see that $600 is the rent for 1 month. So that's what we've used up. We're going to make an adjusting entry to debit rent expense, and we credit prepaid rent for $600. Right? So rent expense is going to be shown on the income statement. And then prepaid rent, which gets shown on the balance sheet, it had a balance of $3,600, but then we credited for $600, so then the balance went down to $3,000. So that's what we would show for prepaid rent at the end of 1 month. At the end of the next month, we'd have to make this adjusting entry again and report another $600 of rent expense on the income statement. Prepaid rent would now have a balance of $2,400. We do it again at the end of 3 months. Report another $600 of rent expense on the balance sheet. And now prepaid rent, the balance goes down to $1,800. At the end of 6 months, prepaid rent is going to have a balance of 0 because we've used it all up. We spent 6 months occupying the space. So basically, over time, that prepaid rent is turning into rent expense. Another transaction we could have seen back in Chapter 2. We buy a 1-year insurance policy for $1,800. So back in Chapter 2, this is not an adjusting entry. This is just recording business operations. We would have debited prepaid insurance and credited cash because we were paying that premium to be insured in the future. Well, after 1 month goes by, we've been insured for 1 month. We have to make an adjusting entry. We're going to debit insurance expense to record the expense. We're going to credit prepaid insurance to show that the prepaid insurance was being used up. And $1,800 was 1 year or 12 months. So that means $150 is our insurance expense for 1 month. So that's why we debit insurance expense, credit prepaid insurance. Next, supplies. Supplies is treated like a prepaid expense. When we purchase supplies, we record an asset account. We debit the supplies, the asset account. we credit cash or accounts payable. As we use the supplies, they become a supplies expense. But we don't make a journal entry every time you go and get paper for the copy machine. You're not going to make a journal entry. Every time somebody goes and takes some paper clips or some pens, we're not going to do a journal entry. What we do at the end of the period, we figure out how much of the supplies we used up, and we do that by counting up the supplies. We take a physical inventory of supplies. We see how much supplies we have on hand. We compare it to what we're showing as a balance of supplies in our general ledger account, and the difference is what we've used up. We make an adjusting entry to debit supplies expense for the amount of supplies we've used, and we credit supplies. The asset goes down because you've used up some of those supplies. So here's an example. The company starts the period with 500 of supplies. During the period, 700 supplies are purchased. At the end of the period, 200 of supplies are on hand. So we have to make an adjusting entry because we need to record the amount of supplies that we've used. We're going to debit supplies expense and credit supplies. So now let's take a look at how much did we use. So we started the period with 500. Whatever we ended period with, last period with, we start this period with. So at the start of the period, we had 500 in our supply room. During the period, we bought 700 more. So if we look at our general ledger account, I'm going to look at it as a T account. Here's what we had. Beginning balance of 500. 700 was purchased. So our unadjusted balance of supplies would be 1,200. That would have been our balance when we were doing our trial balance. Since at the end of the period, there's 200 of supplies on hand, right? So at one point in time, we had 1,200. Now they're telling us when we count it up, we've got 200. That means we've used 1,000 in supplies. So that's why we debit supplies expense for the supplies we've used. Supplies goes down by the amount we've used. So we can see now, after we make our adjusting entry, there's 1,200 on the debit side, 1,000 on the credit side. That means we've got a 200 balance in supplies. That's our adjusted balance of supplies. Okay. Now, we've got one more category of deferred expense, and it's kind of a oddball category, and that's depreciation expense. When I ask students in the classroom what's depreciation expense, somebody always gives me this answer. They say it's a loss of value for an asset. And people, I think of a car. They say once you go and buy a car, new car, used car, whatever it is, once you drive it off the lot, they say it depreciates 50%. It loses half of its value. And that actually, so that's the most common explanation of depreciation, and that's actually the finance definition of depreciation. The accounting definition is different. It's not a decline in value. Depreciation is allocating the cost of our fixed assets to the accounting periods that they are being used in the business to help us generate revenue. So we're talking about our fixed assets, so our plant and equipment, machinery, equipment, computer, truck, building. These are all the things that get depreciated. And so we're not computing the decline in value. We're just taking the cost of that fixed asset and we're spreading it over the years that asset's being used to generate revenue for our business. Okay. So we're dealing with cost. We've got our cost principle. We've recorded these assets at cost. The cost is what we're spreading. It's not the loss of value. However, we don't want to reduce, let's say it's a truck, that's what I got pictured here. We don't want to be reducing the cost of the truck on the balance sheet or in the general ledger account directly. Because we want to be able to go to the general ledger account. We want to be able to see what did we pay for that truck. So we don't reduce the truck directly the way we did with the prepaid or supplies asset accounts. we're going to use what we call a contra asset account. So we've got a special account that goes along with the truck account, one that goes along with the equipment, the building, the furniture. And this is where we're going to show the cost that we've allocated by taking depreciation. So we're going to talk about a few different contra accounts. A contra account is an account that goes along with a related account, and it gets subtracted from that related account. So this contra account is going to be called accumulated depreciation. So instead of reducing the truck directly, we're going to credit an accumulated depreciation account for the truck. So here we go. When we're talking about depreciation on equipment, we're going to record $6,100 depreciation on equipment. And for our purposes here, you're going to be told the amount of depreciation. We're going to have a later chapter where we actually learn how to calculate it. So when we're talking about depreciation, we're talking about an expense. The cash transaction having to do with the equipment, well, that would have been when we bought the equipment. So that happened in the past. So if it happened in the past, we're talking about a deferral. And as I said, the amount we're going to learn how to calculate later. So right now you're going to be given the amount. The way we record that in the adjusting entry, we debit depreciation expense and we credit accumulated depreciation. So we're not going to credit the truck. We're not going to bring the truck's balance down by $6,100, or actually in this case it's equipment. We're going to have an accumulated depreciation account, $6,100 equipment. So the truck is an asset account. It's got a debit balance of $50,000 and accumulated depreciation. We can see in our adjusting entry we credited it, so it's going to have a credit balance of $6,100. And so the difference between the truck and the accumulated depreciation for the truck, this $43,900, this is the book value. This is what we still have left to depreciate. Now, if the next year we took another $6,100 in depreciation, let's say we made the same journal entry again, and one of the methods we use, straight line, does spread out the cost evenly over the years. So the accumulated depreciation would go up to $12,200, and that has a credit balance, the debit balance of $50,000, subtract the $12,200 credit balance. Now the book value of the truck is $37,800. So we're preserving the cost of the truck account by using this contra account. But we can subtract to find the book value. This is what we have left to depreciate, and we're going to see the book value is going to keep going down as the accumulated depreciation goes up because we've taken more depreciation. So when we're talking about these deferred expenses, it's really important that we record the journal entry, because if we don't make the journal entry, the income statement will be wrong. We will not have recorded all of our expenses. Our expenses will be understated. If our expenses are understated, that means our net income's overstated. And then think about it. Net income goes on to the statement of retained earnings. If the net income's overstated, the retained earnings will be overstated. So here our retained earnings, stockholders' equity will be overstated. Our assets will be overstated because that book value will be higher because it's not showing the accumulated depreciation won't have increased. So our assets will be overstated as well. So this is why it's so important to make the adjusting entry for our deferred expenses, because it will then make all of our financial statements incorrect.